I want to talk to you about just that last point that we just hit on, the potential of a sweeping change when it comes to immigration policy. The president saying that he would remove a number of criminal aliens, as he called them. But basically, I think there's an expectation that we could see widespread deportation or just incredible changes when it comes to immigration. How does that impact both the labor market and potentially inflation?
I think it's a huge possible change to the economy. I think what remains to be seen is exactly what the details are and how it's carried out. We had really rapid growth in the U.S., 3% growth in 2023, 2% and 2.8% growth in 2024. And the whole time, inflation was coming down, especially services information. And what made that possible was this large increase in labor supply driven by immigration. And so if you reverse that trend, those same trends tend to reverse. The question is, when does it happen? How big is it? And how large are the overall effects? We've assumed some continued slowing in immigration this year. And as a result, it puts a bit of modest upward pressure on inflation, much more in 2026, because we assume that the cumulative effect of these immigration restrictions just builds time. But we're looking for some extra inflation as well, especially in the services sector.
All right, so you believe change to immigration policy, that might have a modest impact on inflation. But according to your research, tariffs are a very different story. If we do see widespread tariffs, you believe that impact on inflation is immediate, but the hit on growth, that's going to take some time. Explain that.
Yeah, no, that's exactly right. And just to be clear on immigration, the reason why we think the effect this year on inflation is modest is because we assume the restrictions take place over time and they gradually mount. If everything happened all at once and we just shut down the border and started mass deportations on day one, I think that's a very different story that would have meaningful negative effects on growth and push inflation higher. But for tariffs, the evidence from 2018, 2019 is that inflation shows up. There's an inflationary effect on the goods tariff after about 2 or 3 months, so fairly rapid. But then there's also an underappreciated negative effect on growth. Tariffs are taxes. They're taxes on consumer goods, which is about half of what we import from China. They're also taxes on domestic manufacturing and domestic CapEx spending, because we also import capital goods and intermediate goods production. Now, the hit to growth takes about 2 to 3 quarters. So that's the disconnect, is that the effect on inflation is quick, 2 to 3 months. The hit to growth takes about 2 to 3 quarters.
Hey, Seth, this is Mark Short. I think that President Trump has made clear he doesn't intend to address entitlement spending. We're at $36 trillion in debt. We continue to spend, which I think drives a lot of the higher interest rates. At the same time, he's somebody who's going to want to push down interest rates. He tried to pressure Jerome Powell the first time to push rates down. And he also wants a weaker dollar because he thinks that helps domestic manufacturing. How does he achieve both of those at the same time?
Yeah, I think it's a very, very, very difficult combination of things. Now, restricting overall spending is possible, and some of the discussions that have come out about trimming discretionary spending, I think the numbers are bigger than are likely plausible. But anyway, around, lower spending is likely to slow the economy, which is going to let the Fed keep lowering interest rates. But I think the tricky part is going to be, can you keep the economy going as strong as it is right now? The economy is coming off of just an amazingly solid position. Can you keep that going while bringing inflation down and bringing interest rates down? That's where I'm pretty skeptical.
So, Seth, put a bow on it for us. A flurry of executive orders, a lot of rhetoric from the president. How does the Fed interpret all of this? How do they interpret the potential of these tariffs coming in, the changes to immigration policy, the idea of an external revenue service? I mean, you've been in those rooms, you know these officials. What's their take?
I mean, if I'm sitting there with Chair Powell and the rest of the FOMC, you've got to be nimble, you've got to be agile, you've got to be ready to react to lots of things. So there were lots of announcements, lots of discussion about what the goals are. But what we need to see are the actual details, the actual implementation. And let's be frank, I spend a lot of time writing down models, writing down projections, writing down forecasts about how these policies are going to affect things. There's so many variables, it's impossible to know ahead of time. So what I think Chair Powell is going to be doing is they've got a view. They've got roughly the same view we do. Tariffs push up inflation in the near term, push down growth over time. But now they have to wait to see exactly what's implemented and exactly what the effect is on the economy, and then they'll react. I think they'll assume that the effect on inflation from tariffs is temporary, but they'll have to sit back, watch and see what unfolds. And so they're going to be on high alert. And I think whenever that inflation from tariffs starts to show up in the economy, that's it for rate cuts from the Fed until they see one of two things. Either inflation keeps going up, in which case maybe they turn around and start hiking more, or they see the economy slow down materially, in which case they might start resuming rate cuts, but that's not going to make anybody happy.